Good morning, everybody. Good morning from Tampa, Florida, and welcome back to Trend Following Spaces. And welcome. It's good to see everybody back. So I'm just sort of still on a high because my hockey team won last night, Tampa Bay Lightning, and very happy about all of that. We're up 2-0 against Florida, and hockey in the South is pretty fun and different, and it rubs people the wrong way, but all of our team are Canadians and Eastern Europeans and Russians, and yeah, none of them are probably from Florida. A few Americans. Yeah, we do have some Americans. Anyways, it's good for you to start the day in the club and with knowing that my sports teams are all doing well. So tomorrow is my podcast recording with Niels. So I need to use this as a warm up, and I need help coming up with some good ideas and topics to talk to Niels about. He's prepping for me, so I need to prep for him. It's always a little bit of a rivalry. He disagrees with a lot of my stuff sometimes. Sometimes we agree. Um, so I need some help. I don't know if you, so give me some good ideas on topics to talk about. I went through and listened to a lot of the recent podcasts. I printed out the transcripts, underlined a lot of the ideas and the comments, and I was going to go ask Richard some clarifying questions. He made some good comments in his, and still can't get off of Jack and how and that stupid question. It wasn't really a question. I called it a question, but when I went back and listened to it once again, Niels calls it a comment. So he doesn't. So he's correct. I misspoke. It's not a question. It's just this long 4-minute comment about trend following. He doesn't really understand it as much as he needs to. Jack, that is. So recently, I wrote down some of the topics. Rich talked about using different systems and how important that was. That's a good one. Um, Niels brought up this idea of massive expansion of the number of markets. He's skeptical. It doesn't really matter too much if you trade. He goes back and forth, but he's back on to it doesn't really matter as much. I trade 200 markets. I think he advocates for 50, 60 is all you need. He hasn't seen any much difference. And then Rich and Niels talked about my claim, and I know this has got to come up tomorrow, that I came up with this crazy idea that long-term trend following, classic trend following, can make money very frequently. Like every 12 months, it's going to be positive. Well, annually, every year. The trailing 12-month positive return is more difficult, of course, but I'm going to stick by my claim there and talk about it today and tomorrow. And then another one I kind of liked was Mark and Niels talking about the recent performance being about a lot of trends in all the different sectors, pretty much. So we really don't have that much diversification. So that's an interesting topic too. I have some theories on our claim that we sell out for these outliers. Outliers drive the performance, but here recently, every market and sector is driving performance. So we really don't. We are having things move all together, it seems. Okay. So, anyways, I'll mute myself and then start inviting people up, and you can um, make some comments and start the discussion any which way you want to take it.
Hi to everyone. As I always say, very happy to be here. And I'm now in the beautiful forest near the mountains and sea in South Russia. Um, a very interesting topic today and about the markets. And I think it's very interesting for me. And I have some thoughts on this topic about the markets. And I would say that if I would have, if I had deposit this that about rate to 100 markets, I would maybe probably do this. But I think that in a situation where you are limited, it's I have said before this many times. Maybe even 50 markets can be a good decision if you choose them accurately, maybe in terms of correlations. And I think that maybe 50, 70 markets can be enough, can be really enough to be much developed. And so I don't really know exact answer on the question, but I, it can be enough if you. It can be enough. But of course, I would have a lot of money in my account. Maybe I would trade more markets than 70. But very important not to be overweighted here. It's very, very important, and I think it's more important even than have. You must have uncorrelated return streams, and that is the much important factor here. The the most important factor here, uncorrelated return streams as much as possible.
I don't think per se. Can you hear me? Oh yeah, yeah. I don't think per se there's an issue with the way the markets are going now. Basically, very correlated because obviously every market is different. We don't know which one goes out first. I think it's going to be more of an issue if you're long only or something like that, because then obviously if everything is going short, you don't have a market to trade in. But if you're going both ways, whether you're going down and up, I know that obviously when markets go down, the chance of gaining profitability versus long is less. But at the same time, if there are 2, 3 markets and they're going all going down and you're short as well, doesn't matter. I mean, it doesn't matter. And when obviously those will turn around, then that's where the diversification comes anyways. There will always be times where markets will be extra correlated, and then at some point they will get out of sync as well. So, I mean, I don't see the issue there.
G'day, everyone. G'day, Jerry. Look, I'd like to propose that because the classic trend follower is targeting these outliers, that the question of diversification goes beyond what normally people think of diversification as a method to smooth the portfolio return. So, most other forms of technique, they don't have these asymmetrical outliers to deal with, these beneficial outliers, and they're dealing with the degree of benefit from diversification from smoothing a sequence of basically linear losses and linear wins. So they don't have this asymmetry that's present in those return streams. So that's where I think the classic trend follower can go the extra mile and further diversify and still obtain the significant benefits of diversification because of the asymmetry that is well beyond what other techniques can. So I think we fit in a sort of unusual category where the adage of the marginal benefit of diversification doesn't apply to the same degree in our world as it does in other traders' worlds.
Yes, I agree with all of that. One question I wanted to pose to Richard is on the same topic. So let's just stipulate, obviously, that the markets have been really good, and most everything is trending our direction. Long commodities, long the dollar, short the currencies, long short a bit of long and short stocks, short indices. I can still find a few stocks to be long, and short interest rates, and everything looks very good. And everyone, all the CTAs are making money. Now, here's my theory. Well, then I have a couple of trades in the past year or so that would have made my entire year. They would have made 10 or 15% themselves. One market, right? It just went so far. And some of the Grains, for instance, they have gotten very close to that. A couple of them have had outsized moves. I think canola and rapeseed, let's say. So 50, 60 ATRs is typical, but those two I think have made three or 400. So I'm okay, right? I mean, I've made more money because everything is moving in my direction. But if I'm hunting outliers as a stated goal, I have a handful, right? Um, but at the same time, I've been overwhelmed, like the rest of the CTA community, with everything making a little bit of money. Okay, so um, we're still hunting the outlier and thinking that's the best thing to do. But wait a second, now people who maybe even are not as good at hunting them as we are, they're making good money as well. Okay, so here's my theory. Most of the CTAs, they cut their profits short. They volatility manage, okay, and they need these periods where the whole sector moves. I think Mark calls it a factor, and it's inflation, it's Ukraine, whatever. Um, it's the relaxing of the power of the Fed, and this is generating nice trends across a lot of markets. And okay, but since most of them probably don't have an outlier trade that made 2 or 3, 400 ATRs, um, because they don't let the trades go to their full maturity like that because the volatility picks up too much. So they need these periods. Now, the classic long-term trend follower, maybe with the loose pants, when it's all said and done on these nice trends, we may give back more profits than most, because we're optimized for the big outlier to let that thing keep going, not to touch it, not to reduce the position based upon vol management, and also the loose pants, the extra long term exit parameter is going to allow for bigger outliers. So since most of the industry doesn't even trade that way, they're right. CTAs need these big, broad moves to make money because Richard and I, and let's say Mulvaney and Melasinos, and et cetera, we're not the typical CTA. We like these, we get these. Maybe we could possibly underperform in these periods a bit. But so I think that's when Neil says, I don't really see much difference in adding markets. That makes a lot of sense because the typical CTA, it wouldn't make much difference. It only makes difference to us because every time we add a market, we have another opportunity for a massive outlier, where the typical CTA never has much of an opportunity for this massive outlier because they cut it off when the volatility gets up there. Okay, there you've had it. Hopefully I've been clear. If not, I can do it again and shorten it up. But
I reckon that is spot on, Jerry. And so what we're saying is that not all trend followers are alike, and we set ourselves in a different patch to what other trend followers do. And I think this is supported by the papers we see from things like Quantica and the Trans Trend interview with Harold de Boer. In that Quantica paper, it was a very interesting one, and they suggested that there were three broad factors that were responsible for the performance of trend following funds. And in their assessment, they believe that the three factors were the strength of the trend signal, which was one factor. Another factor was the volatility that is in the individual market. And the other was the risk management or the portfolio scaling that was applied at the portfolio level. These three factors, they believe, translate to 100% of the performance returns of the trend followers. And they believe that the trend signal component only represented about 60% of the factors. The 40% related to risk management, which was associated with the volatility or the dynamic position sizing of volatility, and the portfolio scaling function. So I personally believe that that is more a representative scenario of most of the CTAs, but I personally think that we, as these hunters for outliers, we actually dominantly, it's a trend signal that is the thing that drives our performance returns because of the outliers that are represented in our data sample. That is all the difference. That is the difference that categorizes us apart from the rest, if that makes sense. So I see this also in TransTrend when I see these interviews with Harold, where they talk about the importance of portfolio scaling. So they're very much into looking at what they call the degree of concentration of risk in a portfolio, and they will look at the fundamental causal nature of trends. So they won't be looking at correlation in the same way that most people look at correlation of individual markets, but they'll be looking at what is the causal trend and what are the markets that are benefiting from that trend, so that they don't concentrate there too much into one form of trend. And so when there is a general absence of trends and maybe only one trending environment, like the inflation environment, they therefore won't use correlation how normal people do, but they'll say, all right, all of these markets are being influenced by this inflationary trend. So therefore, to reduce our risk exposure to that single trend, we will trade what they call on the outskirts of the trend. So they'll embed not just currencies and metals, which are dominated by that inflation trend. They'll then also look at commodities, which they believe lie on the outskirts of that trend because they're not only a function of inflation, but they've also got, for instance, things such as seasonal factors influencing their trend. So that allows them to diversify their risk in that single trend. Now, that is very clever stuff, and Harold is a very clever bloke. But I don't think we actually do that in our world because we're focused on these outliers.
Yeah, it's pretty interesting. And one of the things that's kind of funny that you said there was something along the line. You insinuated that they see these crazy outlier trends as something to manage and calm down and not be afraid of, but it's not like a welcome. What are we going to do to counteract this huge volatility and trend we see? And then you and I are like, where is this thing? Where can I get it? I need it. That's all I care about. My son here in Tampa, he goes for these fish. He was out there last night at midnight. They said they got a hit at midnight, and they fought this fish, tarpon, for 2 hours. No. I think it was 10 o'clock, and they fought it for 2 hours. He got home at 2 a.m. Yeah, so got to get my story right. But anyways, these tarpon are monster fish, and you know where they are. And because everyone is around the same spot, and you can't keep them, but they're like prehistoric, and they're huge, and it's addicting to get one on the line. Now, if you go around the bend where the mangroves are, a quarter of a mile away, you can catch these nice little calm, small snook and trout and things like that. But the big boys are over there looking for the big monster fish, and so it's like that they're fishing in those same waters, but they don't want to catch those fish, and it's really strange how you can have two different attitudes towards it.
Hey guys, this fishing story reminds me how, and I'm not a fisherman at all, but last time when I went, all the fishermen were fishing there and didn't get anything, and then like my third throw pulled out the big one. So I guess I was lucky, like many of the traders with these meme stocks last year. But anyway, my point was that on the podcast, I think Niels and Mark had made a point about when trading 200 markets, whether you trade them all or you scan them, like the scanning universe. And I know Jerry has said a lot that he wants to take all the trades, that you need to take all the trades. So I guess if you are prepared to take all the 200 trades, if you get a signal, you must have some dynamic portfolio construction and position sizing to be able to trade all these 200 markets at the same time, even if it very rarely happens. So yeah, that was one of their points, and maybe this is something that comes up with you and Niels tomorrow. So maybe you can comment on it, like if you scan the 200 markets and how many signals or trades you usually have at the same time from all the markets.
Yeah, well, you're going to have a lot more, right? And so, but you're trading. One of the things that Richard sort of, kind of taught me the importance of making these small bets. I mean, I knew that in 1983, but he reminded me that I already knew that. So you're taking these small bets, and the more markets you trade, the more you're going to get signals, and you're going to have. I mean, with 200 markets, I don't know how many signals I have, but almost every position, let's say 75 or 80%, is fully positioned. I trade 4 systems, so some of them are flat totally, but some are long one or 2 systems, and some may be short. So it's a lot. I trade long term, so I'm in the markets. I'm being patient, waiting for these outliers. So it is a problem, as Oleg was saying, when we talk theoretically. Rich talks theoretically. I talk theoretically, but also I can trade 200 markets. Rich doesn't trade 200 markets. We understand totally the struggle. And so if you've got 20 markets or 50 or whatever you can afford to trade, that's great. But if you can trade 200, then that's great. I'd like to trade 300. I can't trade 300 unless I tilt my portfolio to too many stocks. I'd like to keep my stocks about the same percentage as my commodities. And I can't find too many more commodities unless I get into the China commodities one of these days. So one of the things also that they brought up was when you trade these markets, you have to you have a risk budget. Let's say you have a 5 units, whatever that means, 5 units of risk. So I just divide each of my 200 markets equally of these 5 units. Well, another thing that happens though is if you traded 5 units with 100 markets, and which I did, and then as over time I've added up to 200. Well, now maybe I can trade 5 1/4 units, right? Because I'm going to take advantage of this diversification, and I can be a little bit more risky. And the same with you. If you're trading 20 markets, you may want to trade 4 units, because 5 is pretty big, and you're only trading 20 markets. But if you can get it up to 50 markets, okay, maybe you can get up to 4.5 units. So there is that theory as well. So it's not true that, you can discount, and we're hunting the outliers. And Niels pays lip service to this. At the end, he says, oh yeah, I do remember Rich saying, the more markets you trade, you're sort of hunting outliers. So you're going to get these outliers as well. We straddle the fence with claiming that, well, diversification is great for smoothness, but we really think it's really, really great because of hunting for the outliers. So, but the majority of the CTA industry, the diversification and is for smoothness. They're all about the smoothness. And I think it was in that Harold Transtrend video, which you got to go back and listen to that thing. It's just amazing. I mean, in a lot of different ways, of course, wink, wink. But they're obsessed with the correlation. So once again, correlation. Yeah, things are too correlated. Let's scale back. Let's do some trades. Let's alter our portfolio because they're really interested in sharp and keeping things smoothie. And here we sit with just chasing the outlier.
One of the things Harold brought up that we really need to take heed of, I think, personally, is that whilst we try to achieve maximum diversification, we've got to really pay close attention to the markets we diversify into. In other words, we've got to eliminate any direct correlated causal relationship in those markets. So, for instance, when we look at trading commodities, when we look at trading our metals, when we look at trading our currencies, we might find in our portfolio that all of these things that we trade, whilst we think we are trading individual markets, they're all tied to the USD. Now, that is what is forcing a common correlation across all of those markets. So when Jerry says he trades individual markets, like stock markets, looking for their unique characteristics. So Jerry will focus on trading eggs as opposed to trading a company that's already highly diversified. What he's looking for there is some unique proposition in his diversified portfolio that is uncommon with the rest of the portfolio. In his logical search, he is ensuring that he is breaking any possibility of common correlated relationships that exist in that portfolio. That's also what Harold does in trading synthetic markets. He will go through his listing and ensure that he is not being dominated by, for instance, US currency or whatever in a bias that exists in his portfolio by trading these synthetic markets. I think as in this hunting for outliers, when we are looking for maximum diversification, it's our logic search in identifying which markets to trade that is so imperative in developing our broad diversified portfolios. And if we can apply that logic, then, and we are also hunting for these outliers, I personally don't think there is a limit to the degree of diversification benefits we can obtain.
Now, I need you to follow up on that because I'm going to bring up another quote of yours, Rich, that in my opinion is seemingly contradictory. And that probably, I know it's not. I know you wiggle out of this one. But now you've encouraged me not to pay too much attention to heating oil and crude being highly correlated. And I've had this experience. I told Niels like last week on this Spaces that, hey, Niels, this is one of your favorite stories to tell. It's when I made 30% in heating oil in December 1990, and I made 30% for the year. And so it was only heating oil, only in December, and the first big turtle trade was Feb heating oil, 1984. Crude sat there, heating oil, unleaded sat there. I don't think unleaded existed. And then heating oil kind of took off. Silver doubled or tripled in price in 1987. Gold kind of sat there. So with that in mind, that we must trade heating oil and unleaded and crude, because what the typical CTA doesn't see, because they don't allow these trends to get going all the time, is that they don't see the big outlier coming from a related market. That's why the diversification piece, 65%, 65 markets is enough. It's not enough because within a small group of markets that are highly correlated, one of them can have an outlier. There is the problem with their strategy. I mean, some people say, I don't even have that strategy to hunt for outliers, so ha for you. But this concern that you have for correlation, how does that jive with we should go ahead and trade? I mean, from the words from your mouth, something like crude and Brent.
Fortunately, in our world of trend following, in our hunt for outliers, we can trade Brent and crude, because when it comes to outliers, we will often find that they are not present in both, because there is something special occurring with these outliers that's giving it this extra nudge. So we'll find that the outlier might reside in one, but not necessarily the other. However, I do believe we can go better than that, one step further, in ensuring that we can break down any correlation that exists between those two markets. And the way to do that is trade crude with US dollars and trade Brent with, say, Japanese yen. So it's what it's doing is it's saying, all right, common to both of them may be that we're trading both in US dollars. However, let's further break any correlation so we can get further sort of distinctness and individuality from these particular markets we trade, so that even though we find that outliers might reside in one and not in the other, it goes further when we break down that degree of correlation that exists within them. So I'm just saying that this diversification we're into is a never-ending exercise where we can always get better and better at it by making sure we're trading unique propositions in our portfolio that are uncorrelated with each other, because we therefore get the full benefit of the outliers that exist, and we also break down the correlation that might sort of impact the volatility when the trend turns across all of them.
Yes, I agree with that. And then you just imagine, I would just guess Harold's response to you saying, hey, Harold, I don't pay any attention to correlation. I don't scale back. Once the trade gets going, I just hold on to it. I'm only in here for these outliers. And I can get very volatile, letting the trades run on. But hey, Harold, guess what I am doing? I've decided to put a few trades on and denominate them in yen because I'm going to get this diversification. You would say, dude, no, that's not nearly enough. You're going to just pussyfoot around with a little bit of dividing your crude by yen so you can get some different, little bit of different movement in the markets and not be so correlated to your crude dollar position. Look, I'm obsessed with this correlation and risk control and not letting these outliers dominate my position. So he would like not think that's nearly what you need to do, but I agree.
He might, but I really went into that podcast really closely, and I never heard Harold use the words dynamic position sizing, because he explicitly actually said in that interview, he said that they will not, for instance, he made a comment, and you posted it as a tweet. He loves a situation where he gets maximum wins and maximum losses at the same time. And what he's saying there is that he will not adjust his position sizes by virtue of the volatility that exists in them, but he will manage the correlations in his portfolio in his interpretation of the trend. Too much concentration in a single trend. But what he will do is he won't, for instance, in high volatility environments, reduce his position sizing. He will shift his allocation into a different area of his portfolio that's on more the outskirts of that trend that he believes might be too concentrated. So he's continually identifying what are the primary trends driving the entire portfolio. There might be one trend, there might be three trends. Three trends are great. But when there's one trend, he forces himself to focus on trading what he calls the outskirts of trend. So there is this primary driver of the trend, but then he'll look at things on the outskirts that are being influenced by that primary driver, but have other factors that can give a degree of protection so that all of them are not sort of going the same direction when the trend turns around. So, but he does not use volatility targeting or dynamic position sizing. I think that's really important. So there are certain similarities between what Harold does and what we do, but he focuses on managing risk at the portfolio level. We focus on managing the risk through our design statement, cutting losses short at all times, letting profits run, but not adjusting our portfolio.
Yeah, and I think that, of course, we must use common sense here. As Niels said, a lot of common sense with these correlations.
Doesn't this mean that Harold tries to somehow predict what's going to happen?
Yes, he's got a macro team. Harold's the TransTrend has got a macro department that focuses on identifying what are the primary trends, and then they pass that on to the portfolio managers to then decide how to allocate different risk concentrations in their portfolio.
The portfolio concentration to markets that you somehow think are on the outskirts of these trends, there is an implicit bet that these markets will start trending at some point in the future. Is my interpretation correct?
I think so, Bruno, and which is different to us because we believe that any market at any time can offer these outliers. But Harold is saying that, well, no, they can actually identify emerging trends, emerging factors that are causing new trends, and so they like focusing their target towards the beginning of trends. So they're much quicker into these things than we are.
Begin to start our positions in the beginning of the trends. The only thing is that we never know if it's the beginning or not or anything. If we have the golden rules of trend following, I think we have the golden question of trend following I learned from Jerry. And that's, what's the sample size of that? How can you affirm such a thing? I'm always bugged about this.
And I want to say that there is no evidence of maybe being successful such a tactic and a strategy. And I'm a big believer of equal expectations, the same expectations in the long run, like Jerry and Niels teach us, and I'm a big believer of this. And I think that this prediction moments in the system, it's no good, because at least it makes your system more complex, at least if even it's have a it's a trend following system with the prediction elements, but as Jerry says, trend following plus nothing. And I'm a strong believer in this, and so I don't see any evidence. I don't see any maybe logic for me personally, at least, to do such things. Because if I did some researches on this topic a few years ago, and I came to a conclusion that in the best situation, if you're the best in this, it will be the same result. But the situation cannot be the best. It will be much worse than would be transform plus nothing. And we, like Jerry said, we can't improve classical trend following, and I'm absolutely so.
Look, I would say, well, there is proof there. Because TransTrend has had a fantastic, validated long-term track record. So whatever Harold's doing, I've got a lot of respect for it. All I'd say is that we don't do necessarily the same thing as him. But interestingly, when you go through in detail what Harold does, he might have a different process, but we've got a different process, but perhaps they're steering towards the same outcome, different symmetries, different perspectives, achieving a similar outcome. But I wouldn't like to say that Harold doesn't know what he's doing. He's an incredibly clever bloke. He's got a magnificent team behind him. I personally think that they set themselves apart from the rest of the trend following mob. They're in their own world. But I think as a group, the classic trend followers are also in their own world. And I think that's very healthy. And I'm very happy with our philosophy. So I don't think we need to have a quant division behind us, a macro position behind us or whatever. We don't need that at all with our philosophy. So at least we can apply this as a rules-based method that is a great result, and totally happy with it.
And I think I said before that, I think that if trend following traders will have target maybe to predict, they would predict the future with a higher probability than macro guys, because trend following traders know, I think, more about how the market is organized than macro guys. They know the structure of the market, and the probability of trend theoretically, if it would be like these predictions, I think guys maybe will be winners here, but we know that there is no sense in it, and we will not be the winners in our performance in this. And I'm sure it's so. And I in interviews of trend following guys, I saw the evidence examples when they in fact predicted the future. Jerry, Niels, Maritz, they predicted a lot of events, by the way. But we don't use it in our trading activity because we don't see any sense of it.
Are you saying Moritz's lunar call in May 2021? I saw that tweet. That was amazing.
Yes, and Jerry, by the way, Jerry said that oil, Brent can be negative, and rates can be negative in 2018. In December 2018, Jerry said that it can be so, and that we are prepared for the situation, even for this situation. And so we have no necessity to predict because we prepared.
Oh, please request to be a speaker. Everyone in the audience, if you want to be a speaker.
Hey guys, one of the things that I've been thinking about, so I trade equities mostly, is managing volatility, and that's like what a big part of this conversation has been today. And the way that I've been thinking about it and working on now is keeping the trend following principles intact and not deviating, but constructing a portfolio on a market neutral basis. So taking out the volatility by putting in positions that are signaling breakouts, but then doing it on the long and short side, adjusting for beta exposure to really cut back on the overall volatility of the portfolio. So on a per trade basis, not managing the volatility, but managing the volatility on a portfolio basis through the selection of securities. So if anybody's thought about that, I'd love to hear it.
So I think I couldn't do that because I need to I need to treat every trade the same way. So I have an entry, an exit, and a stop loss. So I don't want to have a daily diet of massaging my positions with these non-kind of core system trades. So yeah, because I'm not being disciplined, consistent, handling every trade the same way. So I need to do a lot of upfront work. I need to get, is it 5 units of risk budget or 4 or 4.5? So I got to get that squared away. I've got to build my portfolio with as much diversification as possible up front, because it has to be a fixed portfolio. Not only do I have to apply the same system, the rules going forward, I'm going to apply it to the same markets. I can't move markets in and out. Moving markets in and out is no different from the math gods than bypassing a trade. I'm not going to do the next British pound breakout. Okay, well, that's no good. Everyone knows that's no good. They have that discretionary move. But moving the British pound out of the portfolio, missing British pound trades, then moving it back in later, no, that's the same thing. So I can't trade too many stocks. I need to get that squared away up front. I need to size my positions based upon the ATR. So I'm doing everything before I even do the first trade to make it possible and hopeful that I'll never have to do a vol adjustment trades. I'm not going to do a daily dose of vol adjusting, but I really don't want to have a January 2020 issue again where I say, oh crap, I have on too many stocks. Oh, I'm getting crushed. Oh, I have on too much. My risk budget is too high. It was six units at the time. So I need to go in and do a vol adjustment, a risk reduction across the board trade. That's something I think is what you do want to add to your system, but not when you make, you don't want to have to implement it when you've made a mistake of trading too large or trading too many stocks or trading too many markets that are correlated. It needs to be a once every 2 or 3 year situation where all hell is breaking loose and you need to lick your wounds and deviate from doing your system trades to preserving your capital and living for another day.
I agree that if you are a systematic trader, and maybe no matter what strategy do you have, you must be consistent if you want to be robust. And if you are not consistent, if you are not robust, you are not systematic in the end of the day. And so it's not much better than to be a macro guy. Maybe it's it's maybe even worse than to be discretionary. I don't know. I'm not an expert in this, but I'm sure that if you're systematic, you are consistent and you're robust.
I agree with all the Rich's statements about TransTrend. They're one of my favorites. I love TransTrend, Harold. I love everything about what they do. I'm happy, that they don't really veer over into our area too much. We don't need him putting his assets and brains and bothering us with the traditional trend following. So I like. One of the things I didn't understand though, when I keep track of my open trades, and of course, I get out of my losses with pretty well, not too quickly, but pretty quickly, and I risk 18 basis points per trade now. And so when I look at my open trades, though, they're totally dominated by these massive profits that I've had on for a year, let's say. And then there's a few losses, -1, -2, -3, -4 ATRs, just a handful, right? They're close to getting out or they're close to turning into profits. But I didn't really understand. This was very unique from a trend following point of view or a money manager point of view, risk manager, quote unquote, point of view, where he said, "Oh, I like to have big losses and big wins at the same time, and because I know that I'm more diversified." That is not something I've ever heard before, and I couldn't figure out a way to explain that to myself and say, "Oh yeah, good idea, Harold. What do you think?"
What he means there, Jerry, is that for instance, if he's all his portfolio is in profit, he's worried about the degree of correlation that exists in that portfolio. But when he's got a portfolio where he's got maximum wins and maximum losses, he knows that that portfolio is far less correlated. So he is working on an edge that exists between the difference between his wins and losses, which is small, but he was talking about 0.01% per day, I believe, the small edge, but translated over 365 days, it comes to about, or 360 days or whatever, it comes to about 14.1%. So he's looking at a small edge that resides in the difference between his wins and the losses. That's a very clever statement. When I sort of dug down deep into that, I could see where he was coming from. And really, that's what we don't worry about the adverse volatility of our drawdowns. We know that a drawdown is a very necessary accompaniment to catch these outliers. That statement he made is almost exactly the same in his terms than what we feel in our terms.
And I think that, of course, if we have a lot of uncorrelated return streams, we can reduce our drawdown. It reduces our drawdown, and I think so that if this mechanism works, and some of the markets have a good performance, some of the markets bad performance, but if they're uncorrelated, there is a high probability of a drawdown being reduced.
If you guys don't jump in, I got a low tolerance for quietness on these spaces. Well, I was trying to find the exact quotes on my tweet, but then he introduced some sort of like fundamentals, which I thought was interesting. Computers, when we first started, computers were really important. Now it's important to know when not to use computers and more use common sense. I was very interesting. And then I'm pretty sure I got this one right, where the trading itself is dictated by when you have an edge. So when I got involved in trend following, of course, if you hit the breakout, get that trade on, you're going to get some slippage. It doesn't matter. Just throw that thing on. Everyone's buying. It's making a new breakout. You just got to get that trade on and be a part of that. And he was sort of saying like, well, we definitely don't want to do anything like that. we will buy when it's advantageous to us from an execution point of view to buy. So we'll wait until the market maybe goes down a bunch and add liquidity. I'm kind of rambling, but that was unique as well.
Yes, so he refers to his process being systematic but not automatic. In other words, they were saying that the traditional trend follower applies basically an automated process that acts on every signal. What they do is, it is a systematic process, but they will shift their allocation in their portfolio to a different trend area to get this broad array of different trend types. Through a shifting of the portfolio mix, as opposed to just an automated solution that just works on every signal. But when you compare and contrast what he does and what we do, in a way, we are doing the same thing, because we invest in every liquid market. Your example, Jerry, 200 markets, small bet size for each. And you work on every signal that's generated within your universe. But because you've got such small bet sizes, I think you'll find that the process does a similar thing to what TransTrend are doing, but they're trading under lower diversification than you are. But I think the process results in the same thing. In other words, you will find that a lot of your signals aren't activated at any point in time over your 200 markets. So you're not trading continuous systems that are always in the market at the same time. So you'll find that when these trends pop up on the outskirts, your signals will be activated on that. He will be actively shifting his portfolio over to that area to make basically discretionary decisions to reallocate his portfolio to these emerging trends. But your system will have already activated in those emerging trends because you are broadly diversified, small bet sizes. You know, some of them aren't trending, some of them are producing losses, some of them are trending. So I think the two processes coincide, but they're just struck in different terms.
So I found that tweet of mine, May 16th, and just between all of us, because you're all my friends, but somebody mentioned yesterday, Brian. Brian's always trying to cause me trouble or get me riled up. And I think Woody as well, he was like saying, Jerry's always like we have to sort of like deal with Jerry's desire to always be controversial, which is sort of true. I mean, I do it just to have fun. I try to shock people. Oh yeah, I'm gonna be really shocking when it comes to trend following, right? But I do like to be out there and create kind of a big discussion and enjoy that. And a lot of it is just just trying to exaggerate a bit. But I don't think these people pay much attention to me. I don't think I never get the impression they're like, dude, you can talk about us, Winton, TransTrend, Aspect, Quantica, but we're not going to pay any attention to you, okay? But I think Harold might be paying attention to me because he takes some digs, and I thought these were pretty funny. I'll just read these two quotes from Harold, and he's maybe digging at me, but I think it is kind of funny, that he says it this way, because I'm so confident that I don't even, I don't really care. I mean, I think it's just, I'm really happy that he might be engaging me, but not one-on-one, but through Twitter. Okay, here goes. We're a portfolio trader. Maintaining diversification is more important than when should I get in bean meal? When should I get out of bean meal? Should I go long, go short? That tends to be something that someone starting out in trend following is completely concentrating on. So that's kind of funny because he's sort of saying, hey, Jerry, act like you've been around. That's what you learned in 1983. You got to be kidding me. You haven't learned anything since then? Maybe not. I'm not sure. I mean, I've learned a couple of things. All right, here's the second one. The most thing we're trying to do is move away from trading individual instruments based upon predetermined amounts to buy, when to sell, when to buy, when to sell, instruments to buy. Stay away from the old-fashioned idea of systems and signals that have to be implemented, systematic but not automatic. And that's just what I'm all about. that is one entry, one exit, and a stop loss, sample size. And so I think it's funny. I think it's interesting to have, these, especially someone so smart like that. I really am fascinated that, and we're all making money, and that's good. We'll see how it plays out over the next 5 to 10 years when CTAs have good markets and a Fed that's not undermining this. Let's hope. We'll see what happens, but it's going to be really fun for this competition and of money and ideas. I just really enjoy it.
I like the idea of simplicity very much because, as Neil said, that good enough is good enough. And I did a lot of research that I wanted to find more complex decisions to be more effective. And for many years, I did not have found this decision, and I'm very happy that I did not have found these decisions. Because even if theoretically a complex idea on the backtest looks better, I don't know the surprises of execution of this. And so will I handle this execution? Will I'll do all these trades and so on and so forth. So simplicity is a great thing. It's a great idea to be simple.
I agree, Oleg. And I love these to and fro's between different philosophies in the trend following camp, like the dig from Harold, which was clearly directed towards Jerry. I read that as well. But the thing is, we haven't been killed off yet, and we're performing really well. So I think there's room in this trend following camp for different philosophies, but it's very interesting. And I love the engagement because it does force you to look at your philosophy, question it, and I think that's always healthy. In continually sort of taking on board new ideas, whether you accept them or reject them is a different story, but it is very useful.
Yeah, I agree totally. It's so much fun, and I think how many times I have heard something, it can be worded in a way that's totally ridiculous and not honest. Honest in the sense that the other person is really not digging for the truth. It's a mischaracterization of anything I've ever said. I don't like that. But there's been so many times I've heard stuff from people that intrigues me, and I'm like, wait a second, that is much different than what I'm thinking. And I think that's totally wrong. Only to have to revisit that at a later point and say, oh, yeah, that's good. I like it. I used to file those things away. If I didn't understand it, especially when I first got going, I would hear smart people talk and I would just say, I can't understand it right now, but I'm going to write that down and keep coming back to it until I can get to the bottom of it and accept it or reject it. And I think it's just so much fun to uncover those nuggets, even if it comes from other people, and you initially sort of wrote it off. One of the things I used to always think, because when I got started, I had money from a group that put together multi-advisor products. So I would be multiple CTAs in the same fund, or could be other strategies in the same fund as well. And whenever I met some of these new traders or traders I had never met before, I would ask them one question. I was very concerned. Are you a trend follower? And they'd say no. And I'd be so happy. I'd say, okay, cool. That makes me feel really good. I don't want too many trend followers, because I was sort of brought up on this idea that, too many people doing the same thing is going to be a problem. Then Rich comes along and he convinces me that no, it's quite the opposite. It is that these convergent traders, they're the ones causing us problems, because these trends are taking off, we're long, and then counter trend people, convergent strategies, they come in and they cause volatility, momentary drawdowns. Our exit may get hit, but it's causing this uncomfortable drawdown. and then going back to the highs or whatever, and the trend continues. So to some degree, Harold maybe has a little bit of convergent ideas in his strategy, even though he may call himself or want to be in the, most people would put them in the camp of trend followers and CTAs, but actually maybe some of Harold's trading would cause us more bumpiness in the long-term trends. What do you think?
Yeah, I personally think that's right, Jerry. So my concern with convergence is that why even convergent trading strategies can do incredibly well over 2-3 years when the regime is favorable to that strategy. And they offer these beautiful equity curves. And you think to yourself, gosh, why don't I invest a bit in a convergence strategy as well as a trend following strategy? But what you're doing by sort of introducing convergence into your portfolio is that you're introducing negative skew into your portfolio, and you just don't know how much that negative skew is going to cost you in the long term. So it's not that they perform well. In certain regimes, they perform very well. The real question about, allocating towards different techniques as opposed to divergent trend following is that we know that our method itself instills positive skew. We're never the victim of negative skew. So by introducing negative skew into a portfolio, it seems to be a good idea when you're chasing returns to produce that slightly greater return when things aren't trending. However, you are introducing this negative skew, which can really detrimentally affect your compounded wealth over the long term.
How did you like my my tweet? I didn't know if I was taking a cheap shot at Jack, but I didn't really care about that. I mostly cared if my tweet was sort of accurate, which was, Jack saying that in almost all regards except skew, vol management outperforms classic trend following that doesn't use vol management. And then my comment was, yeah, except for the most important characteristic, vol management is better. I mean, yeah, it's the most important thing going.
You nailed it, Jerry, because that's exactly what I was thinking when I coined that tweet. I was thinking of Jack, and then you came out outright and then mentioned that superb tweet. And then I think Matt responded with burnt, and I think Brian Silcott jumped on board. I just hope Jack isn't there sort of thinking, we're aggressively hunting him down, But it certainly made a great point.
And I want to say a joke that I have seen that if you don't buy anything in a shop in Russia, prices are pretty nice, folks, if you don't buy anything.
Hey guys, I'm having some connection issues here. I'll try to speak this last time. If not, well, I'll give up and just listen to the conversation. And on this skew thing, I feel that most portfolio managers that call them quantitative, and I put trend following in this space, I feel that they put the manager as a savior of last resort, as if his judgment is enough to see if the system, if the model is going off, and then he can shut it down as soon as he perceives it. But we as trend followers, at this classic trend followers, I say that we put a lot of confidence in our model and our ability to figure out if the system is robust enough before we put it in the water. We put it to work. When there is a comment such as that from Jack, that the vol management is superior in all aspects except for skew, I feel that somehow he thinks that he's able to perceive if the risk is too much, if he's going south too fast, and then he can shut his system down. Where in comparison, we with our classic trend following models, we are much less confident of our ability or to to predict, to see if the system is going well or not, and we put all our trust in the system, or most of it, I would say. And just a small provocation here, Jerry. By the way, Jack got so under your skin. I wonder if he is some kind of alter ego from you.
Oh yeah, I agree. I don't trust this quote unquote Jack person. I don't know who Jack is, if Jack exists. But yeah, I mean, wasn't so much the question. It's just the whole situation. He wasn't. He did not deserve a 4-minute part of any reasonable podcast. But I would not been happy if I'd have been given that question. Yeah, I'm not a fan of that type of question. And another thing I wanted to bring up, mainly because I just forgot what I was going to say, but another thing that came up in the podcast recently was this idea. I just want to be clear on this and get you guys to tell me if I'm wrong. But there was this comment that was made, well, it just brought up this idea. What's the difference between a back test that has 5,000 or 10,000 trades? And I think there's at least two different kinds of back tests like that, And one is with all of these ideas and situations that, let's say, Harold has, or Quantica for sure has, and all the things I hear about a lot. There are so many trades. I mean, there's like 20,000 trades in some of these back tests. And so, the comment can be made, but wait a second, this back test did have a lot of trades. Okay, yes, true. That is true. However, it's not a question of how many trades it had. And then I think, oh yeah, someone criticized me on Twitter for saying, that I wasn't really saying that. A lot of times I won't say like it doesn't have a lot of sample size. I'll say I don't know how to count the sample size. It's another element as well. Like I really don't know how to count. I've tried to think about this, but it makes my head spin. I don't know how to count sample size as it relates to a lot of volatility management, whether it's portfolio, whether it's correlations, whether it's just outright ATR increases per position or things like that. Because one of the things that you have to do is you have to, I forgot the word, you have to put together the entry and the exit. So if you have an entry exit stop loss, you have to take the entries and pair them up with the exit. Okay. Then you take the entries and pair them up with the stop loss. Oh yeah. Oh no, we've got to play by the same rules. You don't say, oh, I had 5,000 trades. Well, but some of them exited differently. That's right. You got to count them differently. And so that's one group, that's one basket. The other basket is the breakouts that got exited by the stop loss. Okay. Now you can just imagine you have that same thing where you have the entry, exit, you have entry, stop loss, and then you have entry. Part of that, if you bought 10 contracts, 2 of them may be peeled off because of correlation. And then 2 more may be peeled off because of an increase in ATR. 2 more may be peeled off later because of an increase in overall portfolio risk. And then 2 of those may be put back on because vol went down. See, this is how complicated this is. And so you have your 20,000 trades, but your buckets are getting smaller and smaller. And we're saying, you should have thousands of trades in each bucket. All right. Sorry for the long-winded.
And I think that we must understand that in different environment, we can see different results. And environment regime can last for 10, 20, maybe 30 years. Maybe I'm wrong, but I think so. And so, if we have some kind of not enough strategy, it can show like I think maybe probably artificial intelligence strategies. It can show pretty good results for maybe for 10 years, for 15 years. But as Neil said, that if environment will change, for that types of strategies will blow all their phones. So I think we have in our 24-1 world, we have ability to have a good, clear backtest. We have and we understand the logic behind the backtest, behind the strategy, and it's very important to understand how the strategy will behave in different regimes, in different circumstances, and it must be adaptive for unknown future because future is unknown, and like as Neil said, that we have lost our imagination. What can be, what can be, and it can be a lot of things that we haven't seen. Like Jeff says, we have never seen a lot of things that we will see. Maybe tomorrow, maybe in 10 years, but we will face this. And our strategy is prepared for this because it's adaptive. And if we are talking about some convergent strategies, I don't see, or artificial intelligence strategies or something like that, I don't see that level of adaptiveness there. I'm not an expert in these systems, but I don't see for me personally.
Jerry, you're spot on in that if, for instance, your models that you apply for your trends following strategy have variables that are static, you can use sample size over the entire backtest to determine, to give you statistical validity. However, with dynamic position sizing, that is based on information at the point of entry into a trend to the exit of a trend. And that dynamic position sizing is a variable that, it varies over the course of that position size and it totally disrupts the sample size. So you're right. There is no way you can effectively measure the sample size of something that dynamically adjusts over the course of a trend. So there is more robust statistical validity in the static variables applied over a backtest. And so does that mean that you've got to trade those same variables over the entire, over your entire history? Well, no, it's over your backtest that you undertake your testing and your robustness testing over that set of variables. But you can then apply a backtest, 4 years later that still is robust over a 30-year time frame, multi-markets, etc., which will change those variables. But you've still applied those static variables over a very large sample size to make that adjustment. So what we're arguing is that our method is valid in terms of sample size, but people that dynamically adjust, well, no, they're adding this additional complexity into their models, which are based on a single sample between entry and exit, making their decisions for them.
Hey, I'd say that there is one way to backtest, in that you transform the price series into some return stream, and then you calculate all your statistics based on some time frame dimension. You look at the daily returns and the volatility of that, or monthly, weekly, whatever. And I feel this is an inferior way to backtest. I much prefer the way we do. That's based on trades. You evaluate each trade independently and treat them as your sample. And in this camp, I would say that if you're treating the augmentations and peeling off of positions as trades, you slash your sample size completely. Just like Jerry said, you have a lot of buckets to put the trades on. The sample size in each bucket will be very, very limited. But I think the way to go when evaluating this thing is trying to transform the return of each trade in some dimension that will be somehow less sensitive to volatility. The way I approached it when I tested this, the validity of volatility targeting in my systems, far from perfect, but anyway, it's the way I thought about it, is to instead of measuring the return in terms of initial ATR, I measured it in terms of current ATR. Each day, it's as if it's definitely a hypothetical case. I don't think it's even possible to go about markets this way. But it's as if each day I would increase or diminish my position based on the previous day ATR, and so that the return of that day would be the current ATR. So that as time passes, the accumulated performance of each trade will be the accumulated variation in terms of the varying ATR and not the initial ATR. And well, I've already told you guys this system performs much worse than the one that Let Profits run for basically obvious reasons. It's not following our golden rules. But anyway, I wanted to test it, and I think that what TransTrend might be doing and Systematica, if they are performing their back tests as we do, as based on trades and not on daily performance, I think they're somehow transforming these return streams in a similar way, just to preserve a sample size again.
And like I've said, I don't ask the computer to optimize my simple parameters, like the breakout entry or exit. I try to just look at the charts and come up with what I think, is going to allow me to hang on to these big trends. And I'm going to have an average holding period that is probably like a year. And then I put those parameters in the back test to see if they work. And they do. And so you could say that's semantics, but I really am not ever asking the computer to optimize even the simplest of ideas. And so, but then when I come up with my 4 look back periods, they do all make about the same amount of money and have similar performance overall. But that computer was made for complexity. And just think about how good it is at going in there and optimizing as many variables as possible to have this, to tell you this is the output, this is the parameters you need to have the smoothest possible return. It's amazingly good at that. And it'll tell you exactly when to overweight, underweight, use your vol management, how to use it. It's just an amazing, it's really good at doing these complex things. I've done that before. I honestly did it before. And it was the start of 2006, I think. And we saw performance of the first few months of 2006 that we had never seen in the back test. So there you go. And it was not good. If you were wondering, yeah. So more power to them, but I guess I haven't learned too much since 1983.
I think this is one of the gems in Rob Carver's book, that there are systems that are ideas first and systems that are calculations first. Honestly, I don't remember the name, how it calls it. But the ideas first is the one that you you just said you approach how you approach ideas now, that you have the you have the you have that idea and then run the back test to see if it's valid.
That's exactly right, Bruno. If it's adopting a design-led approach first. So in other words, you've got to know what edge you want to target, and then you specifically design your system to capture that edge. So there's no question that if that market exhibits those properties, that system will be able to catch it. Then perhaps you can afford to put it into a back test and optimize certain parameters within that design process. But if you leave it up to the computer to do all of the legwork in actually coming up with that design, it is going to come up with an over-optimized solution that's going to fall off the cliff as soon as you take it live. So it's all about methods to sort of avoid the propensity using these powerful computers to overfit your results. So we specifically adopt this loose pants methodology, which is an underfit response. It's a necessary underfit response because we're not interested in the individual characteristics of each market. We are just interested in these outliers that are exhibited across any liquid market. So therefore, we don't want something that overfits to a particular market condition. We just want a design that captures these outliers. So that's why Jerry can eyeball the charts and say, right, these are the outliers. These are the designs, the principles that I need to capture those, gives it to the backtest team, and they come back, oh, gee, Jerry, that's exactly right. It is robust in backtest world. And that's because he's adopted this design-led first approach.
So if I just read you this quote I tweeted in December of last year from Mark. Overfitting leads to a model that too closely follows a particular data set and will thus fail to fit new data or predict reliably new observations outside the initial or training set. You will be disappointed during testing out of sample. Trading out of sample, trading in the future. Okay, so here's the second part of that quote, and it's my pinned tweet. Yeah, this is to know Jerry. Is if you want to know me, this is one of the most important tweets. It's a total quote from Mark. I have it pinned. I've had it pinned up here since December 31. The classic trend follower is willing to suffer from underfitting rather than finding a model that does well in backtesting through adding a significant number of features. The trend model may do worse in training, yet may have better success out of sample. There you go, in a nutshell. Be fearful of the future and don't grab too much comfort from the backtest in the past, and lighten up and don't be stressed. I've done it both ways, and I wouldn't advocate this way if I hadn't have made mistakes the other way.
Hi, everybody. You guys teach me so much. I appreciate it. I don't know if this is too simple a question or if it's a topic, but Jerry, you've mentioned risk budget a few times today, and I was wondering, is that from a money manager standpoint, is that arbitrary from manager to manager? Is there a formula that you come up with saying, I've got $1 million under management, I'm gonna 15%, 20%? I didn't know if you could comment on just risk budget in general.
Well, it's a way of formalizing and systematizing and using formulas, and it's a total money management, and I'm sure it's in the public domain. But it's basically saying, like, if you take 5 units, then let's say, what does 5 units translate into? So 5 units translates into, if you had a normal day, if it was a normal day, an average day for each market, and they all went up, you would make 2.5%. But that's based upon the entry ATR. So that's a lot, right? So an average day, but I could be down 2.5%. That's right. And that's based upon entry ATR. Some of the ATRs are now 4 or 5 times that. What are you doing? Yeah, that's right. And so I'm not going to give you the equations, but you can figure it out. And so if you take the 5 units and divide it by 200, then that's 0.03. And then so it's really small, but still the budget is large. And what if everything does that? I remember 2020, some things did that. That's right. And so, but it does sort of, then you put that 5 units in the back test and you say, ooh, that's too much, or that's too little. It's pretty wimpy. I want to do 10 units, or I'm going to do 2.5 units. And so when you do your back test, you sort of normalize the risk, and then and you say, okay, in this back test I used 10 units, but I'm going to cut that in half or cut it in a third. But it just speaks to the power of these typical CTA portfolio that allows you to get away with seemingly a high risk budget. I think 5 is pretty hefty for my taste. I've traded a lot larger and was unable to manage the drawdown psychologically, and I would have to cut back my leverage frequently. Only at the wrong time to see the markets turn around and do well. So you want to kind of get out of that. You want to choose this certain unit size risk budget that's based on your site. It's the one area where you have to sort of use discretion. Like if you get if you do some back testing on your 1 entry, 1 exit, and a stop loss, and it comes back and says, well, I can't handle some of these draws. It does make the most amount of money. Just like Jerry said, it's an amazing money generator, but some of these drawdowns are too big for me. I'm going to add some non-robust elements to it. No, I mean, be a man, understand if you can handle trading, if you can handle doing the right thing. Don't add in things to your trading that are nothing more than systematized discretion, or find a new career. However, in this one area, obviously, yeah, you can trade if you have a lot of fear of over trading and having a lot of volatility. Then do 2.5 units or 4 units. But if you don't, then you can trade larger. And but don't compromise don't try to have it both ways. Compromise your system, making it less robust. I want to trade large and make the money, but when the big drawdowns come, I won't wait for the exit. I'll get out with this other rule, as if this other rule has this magic power, when it's nothing more than discretion, and it's destroying your sample size. And we've all been there, and we've all had these thoughts and implemented them sometimes. It just goes to show you, though, how powerful currencies, commodities, stocks, bonds, longs, and shorts, and how much diversification you get. Because I've traded a stock-only portfolio, and I mean, gracious, maybe if you could trade 5 units diversified, probably, way less than that if you're trading stocks only, bonds only, commodities only. It really is a powerful to have all of these different markets and the shorts as well.
Jerry, it's just a terminology question, but I've got a little confused here. When you say 1 unit, then you mean how much one initial ATR will impact your overall portfolio, or is it the one trade? Is it, for example, if your bet for a trade is 30 basis points, and then 1 unit is 30 basis points, or if in this trade, suppose you have 5 ATR of stop loss tolerance, then 1 unit will be 30 divided by 5, and that's 1 unit means 6 basis points, because 1 ATR move will deplete your NAV in 6 basis points.
That's right. So back to my original example, if you're trading 5 units, a typical day is going to be half that, half of an ATR. So If the market moves half, and so the ATR equals 1%, and if the market moves a typical day half of an ATR, you'll make or lose 2.5%. So it's just a systematic way of putting together a risk budget based upon ATR, and but it kind of starts falling apart on a contemporaneous basis because the ATRs are so much different. So I look to see how many units I have on at entry, so it's never going to exceed 5. But then how many units do I have on now based upon the current ATR, And so that's like a lot more. It could be a lot more than 5 on some of when we're making lots of money. And so, I'm doing a lot of stuff like trading small. I'm trading a lot of markets. I'm trading a moderate risk budget. I'm changing my trade level slowly. As I make money, I start to increase the AUM, the trade level that I'm using to base my new trades on. I increase it slowly, So if I'm up to 100 million in AUM, maybe my trade level is 80 million, right? Because a lot of that 100 million now is open trade profit. So I'm doing all of these things in the background because I'm very conservative. The one thing that I'm doing that's kind of blowing it all up to some degree is I'm pushing all of that crazy risk on the new trades, on the open profits. So I've got my defensive line at that trade level, but I'm going to defend that. Small losses, it's artificially low, lots of diversification. But so I'm pushing all of that risk and volatility where it needs to be, which is in these great outliers. And it just so happens the more you let them run, the more volatility you give them, the more risk and troublesome you're pushing out there, the more money you're going to make. It's just a crazy phenomenon. And then you run into, why doesn't everyone do that? Because they cannot do it if you introduce Sharpe or vol management, or you're concerned with vol. Like vol on my capital, I'm very concerned. I don't want to eat into that capital. There's 18 basis points with a system that makes money 40% of the time. That's worrisome, right? But pushing that out of there and putting it mostly into open trade equity where I'm making lots of money, and that's where I'm putting my volatility. Why should I even care about that? Especially when you look at it to say, if you don't care so much about it and you have these loose pants, you make more money. It's beautiful. It's a beautiful, beautiful thing.
Very helpful. Thank you for that.
You've been quiet today, Mike.
Hey, what's going on?
You made him put down his Bloody Mary and hand it to somebody because he's in the pool or the hot tub.
Actually, I'm not in the hot tub right now because it just started. Looks like we're getting a tropical storm here in Tampa Bay, Jerry. So I'm inside in the office. Yeah, I had a couple of thoughts that I was writing down while I was listening to you guys talk. And one of them was, Jerry, do you ever look at, or others, do you ever look at, when you talk about diversification amongst all these markets, do you ever look at the return drivers of what the actual, some people I know segregate various trends or markets into categories of return drivers because there are certain specific things that drive the returns of some markets, so they're fairly correlated themselves. So I was curious if any of you actually try to determine or categorize them into return drivers.
I mean, I think about it, I read about it, more importantly, I look at the portfolio and I see everything making money, and I'm like, oh gosh, this might not end well. Especially, ending well might be defined as I want to make a lot of money and not give a lot back. So I think as a good, 100% technical trend following trader, I'm going to try to focus on not being able to predict, being surprised, it's so obvious that this inflation trade is going to impact the commodities and possibly the dollar is going to impact the commodities, and it's all going to come tumbling down. And then this was what drives people to find that trading this strict style is so intolerable. They just cannot do it. It's so obvious that I did not need to suffer, in some of these times where it was obvious to everyone this was a single trade. Corey tweeted something a few weeks ago, within the past few weeks, something like CTAs pretty much have on the same trade. Yeah, I mean, we get it. It's just that I think historically, I think we'd be surprised how often the markets did not do what we thought they were going to do. We actually did. It was worth having on these diversification, these positions that seemingly looked like they were all dancing to the same tune. And then, yeah, they did all crash. But you know what? Some of them went back up to new highs weeks and weeks later. And if you had just held on, i.e., followed your system, you would have gotten a way more diversification, at least in terms of profit and loss. And I think that's what we're all holding out for, that historically we have a robust system with very few parameters, and introducing other things, it might happen, but it also may torpedo our ability to make money in the future.
I must admit that a major research piece that totally changed my mind on this thing we call trends is what that Jean-Philippe Bouchard put out, where he looked at the major price moves of minute data and categorically concluded that 10% of those major price moves were a result of news-related events or exogenous factors, but 90% were these endogenous factors, which made me come strongly into the behavioural camp, showing that these major trends, these major outliers that we're focusing on, is a result of this sort of synchronous trader behaviour that causes these amplified events, and it's what you look at, Mike, with your asymmetry and with your behavioural approach to understanding trends. So when I look at things such as these trend drivers, I tend to sort of push them away as not necessarily being relevant for the type of trends that we like to target.
I really agree with that. That had a major impact on me as well. I think that's a really good thing. Go ahead, Mike.
What's the name of the paper?
Look, it was so Jean-Philippe Bouchard. You'll find him on LinkedIn, and if you scroll through it, it's in relation to his research on what causes major price moves. He looked at minute data extensively across a vast array of different equities, and his conclusions were quite profound. And then he started looking at, supportive research with new theories coming out in, these complex adaptive systems research, which started to really fit together and tell you how to amplify that minute data response up to the macro scale, which certainly answered a lot of questions that totally undermined efficient market hypothesis, that sort of stuff.
There's a blog piece on Top Traders Unplugged by the eminent Richard Brennan and from March the 2nd this year. I'll send you on a private message, Mike.
Okay.
One thing I wanted to mention is I want to switch topics a bit here. We don't have a lot of time, but I wanted to run this by everyone, Rich especially, because I'm going to make this a focal point of my talk with Niels tomorrow. And that is the skepticism that, and I really enjoyed this part of the podcast with Rich and Niels, but both of them were very skeptical of my claim that classic trend following strategy can make money every year. And so it has a lot of things that are negative, but it's very consistent. And so I well, then I had to go back and make sure, I wasn't over exaggerating. And then, just unrelated, I stumbled onto this old file in my Google Drive from many years ago. And I looked at this piece that we sent out to investors and prospects. And we listed, it was how we trade, and then it showed our returns. And I had 13 years in a row of winning years. And trust me, I'm so much better now. Obviously, I'm joking, but obviously I'm better and I trade better. I have better systems and I trade a lot more markets. Okay, so I was like, okay, that doesn't mean a great deal. I mean, because obviously, whenever I talk about this, I always say, you got to be lucky. You got to be a bit lucky. And then a research guy within the past 6 months, he did this research on one system that we trade, and it went back to 1977. And I asked him how many losing years, and he said 0. Okay, so that I discount a lot because some of the years were maybe positive less than 1%. So obviously, it could go either way, and it has a lot to do with the markets you choose and the systems you choose. And certainly we hamstrung it a little bit because we only use one system. But okay, so, and then of course the past 10 years, I'm almost positive that there's no way all of those would have been positive. There's just no way. So I think up until like 08 or 09 or something around there, it wasn't that hard to figure out, to run a back test and see performance be almost every year made money. Now, the trailing 12-month performance, much harder, much harder. I remember us doing that research and trying to see how close we could come, sticking with one entry, one exit, and a stop loss, but seeing how close we could get to percentage of winning months, trailing 12-month periods. And I think we were not close to 100%. So that's much harder. So once again, it takes luck. Okay, but that's kind of interesting or whatever. And the markets have changed. It's never going to happen again. Okay, whatever. Maybe. We'll see. But I did think that as Rich and Niels were talking, they started veering off into this other other subject, which I thought was fascinating. And I was like, oh my, this is fascinating. And it was that maybe this whole idea that I had come up with was anti-trend following. It's anti-trend following to a degree. Our strategy doesn't attempt to make money every 12 months or every year or frequently. It just doesn't sound right. And I was like, yeah, I get that. That's not a bad initial reaction, but still, I'm right, And then I got to thinking, one of the reasons that people wouldn't pick up on this, because no one trades one entry, one exit, and a stop loss. You don't see this in the CTA industry because they don't let profits run, right? And I think what's ironic about this, and then at some point, Niels or Rich kind of speculated, well, the only way we could kind of figure out that Jerry could possibly be right about this is he would have to be volatility managing. And we know he doesn't do that, but still, volatility management would have to be a part of this. And at this point, I'm just having so much fun listening to this. And then I thought to myself, no, it's the opposite. It's the opposite of that. And it's not the idea that, like, and this is the way I've explained it before, and that is, come on, we have a low win rate. We're hunting outliers. We never we let profits turn into losses. We let big profits turn into really small profits. We don't do anything. Can we please have this? It's like the computer is saying, I'm not going to give you a good Sharp. I'm not going to allow you to do well on a lot of the trades. You're going to have some embarrassing givebacks, some drawdown periods. It's going to be very painful, but I'll give you one thing, and that is you'll make money very frequently, or more frequently than almost anything else. And it's ironic that you would think that in order to get that consistency, you would have to manipulate it and throw in a way to preserve some of these profits. Like you're sitting there in June with a lot of open profits, you could actually not make money this year. And so the way to ensure making money is to do something funky. You've got to scale back. You've got to do something other than waiting for that one exit. And yet the back test says, no, you don't. That's the whole key. The outlier, letting it go, letting it run, it will carry you home more frequently than anything else. You'll be scared to death. You'll swear you're never going to pull it out of the fire. It's December and you're down on the year. But ironically, the thing that's the most consistent and the most trustworthy is relying upon these outliers and not doing anything to manipulate and manage the frequency of the profits. It's to let it go and do nothing. And then that's going to be your reward, to be very consistent on an annual basis. I'm going to stick with that. Now, historically, I'm pretty sure that's all true. Going forward, I can't make any promises. And probably trading more markets is going to help you in that regard as well. Wow, that was a lot. I'm sure I got it all in, but I'll leave it at that.
It was a great discussion with Niels, and I had a laugh. Niels was the one who was saying perhaps you were volatility targeting, but what I was saying was that I was saying there's this god called Jerry Parker who is so diversified, 200 markets, has significant capital under his belt. What he's experiencing is different to what I'm experiencing with much smaller capital, much lower diversification. So my thoughts were that what you're experiencing is the fruits of this philosophy where it really sort of pays dividends. In other words, extensive diversification, small bet sizes, massive capital. And I'm saying I'd like to trend. I'd like to become this god like Jerry Parker. So I'm prepared to invest in that approach towards that direction and that end. But I think the things that you're experiencing, which is probably very true, this no sort of no negative performance on an annualized basis is probably a result of your process done to the max.
That's right. And it's not anything I'm targeting. I can't help myself. It's not anything I can make happen. It's just what the markets have made happen. And once again, this classic trend following that maximizes CAGR, trusting. And I didn't manipulate it. I didn't try. It was just this results of this simple back test. And I think that if you want to ensure that you do not give back too much profit in some of these open trades, you must vol manage, because vol management is just another code word for profit objectives and taking money off the table because your trailing stop is so far away. And in order to be successful, you've got to have loose pants on your trailing stop. But loose pants on the trailing stop means today, this month, this year, this quarter, you may be up 10% and lose it all back. So I understand that part. I'm sympathetic, not critical. I know people are rational and doing what they think is best. But all I'm saying is, for the longer term period, the computer tells me, and of course some of my past experience has been, if you don't care about that, you have no care at all, it could all go away. It doesn't go away, and you get tremendously rewarded.
I hope you're recording this segment. This has been a wonderful discussion, and I liked your.
Hey Jerry, hey Rich, hey everyone. I obviously feel compelled to join into this conversation a little bit here, even if I got into it late. Just a quick question, Jerry, and we might pick it up tomorrow when we record. I didn't quite catch. So your results in terms of actually achieving a high consistency on a rolling 12-month basis, was that based on kind of your current methodology, meaning everything you've learned, all the diversification you've done more recently? Or is it something you see in just any kind of simple trend following system?
That's a good question. Um, well, as I stated to begin, I had 13 years in a row when I started with with the actual performance. We made money every year, and that's how we grew so fast. People are very greedy, and they don't care about your drawdowns, but you're making money all the time. Now, those systems were shorter term. I don't think I was nearly as disciplined and consistent. It's pretty much a one-man operation. I had a couple of people maybe, and but then we got away from that type of trading because we just needed to improve and do better. Well, you can do better. 13 years in a row. Let's just try to do better, right? This is what you tell yourself. But then when we got back to being more dedicated to the classic trend following, we would build those simple systems and run them in the back test and probably use at least 4 or 5 different look back periods. And the results were coming up the same. And I've told this story recently, which is in 2007, I had a horrendous drawdown and it was out of control. And I made some mistakes on the choice of leverage, and I had made mistakes on implementing some new systems, and it all fell apart. And we had this huge drawdown in the summer, and I remember going into the research staff saying, and everybody it was like a morgue or a funeral, and I said, hey, we're going to make money this year. They're like, what? What are you talking about? I'm like, yeah. They said, why do you say that? I said, because these systems have never had a losing year. So I do remember saying that. And so I do remember, at least around that period, that our back test had confirmed that. But by that time, we were trading better systems more long term.
Yeah, no, that's quite interesting. I mean, one of the things, and I guess why I also felt, and I haven't looked at the numbers, maybe I should before we speak tomorrow, is that if systems can do that, which obviously I don't doubt that that's what you found, I would also imagine that we would have more time at new all-time highs, meaning that we don't spend so much time in a drawdown, which that's how I just feel most trend following systems are in terms of their VAMI curve. But it's a very interesting observation. So definitely worth exploring. And obviously, if CTAs or trend followers can do that, on top of everything else we can do, it just makes it even harder for people to say no.
One of the things you said recently on some of the podcasts is on different topics is that you'll say, like, I just don't see that in the data. And I'll say to myself, I agree. I don't see this. Who has this track record? I don't even have it because I haven't been that consistent and disciplined in following my research. So, and that's because the typical CTA, to quote Quantica, the typical CTA doesn't fully let profits run. And so you're not going to see it. So a lot of these issues of, does it really matter to add more markets? It doesn't seem to matter that much. I don't see anybody out there who makes money all the time, every year or almost every year. And I think a lot of these issues they're strictly because when I have to do these back tests, and for a lot of my track record, I have only traded one entry, one exit, and a stop loss. And it's very scary, and it's not what the typical CTA is doing.
Yeah, no, I agree with that. I think it's part of the evolution. I see that on our research side as well. If I look at what our current models look like, and I look at a back test of that, I do see what you are saying, meaning much better ability to deliver that kind of consistency. So I think it's part of the evolution. It's very interesting, and as I said, I think if we can do that going forward and then stick to it, so to speak, and not make too many deviations from that, I think in 4 or 5 years, once people have seen what this trading methodology with its improvements and evolution is capable of doing, I think it's going to be very interesting to have those conversations with people looking at our space.
Exactly. And as I said earlier, I'm sure the last 10 years, there's no way, whether it's one entry, one exit, and a stop loss, whether it's a lot of vol management. I mean, I don't think there's any way in the last 10 years that all 10 of those have been profitable, because we just hit a stretch where we weren't getting those big trends like we used to. So hopefully going forward, we can we'll see more typical markets that's where we do see more of the outliers. And that's been the thing that all the studies have shown, AQR and others. What happened to CTAs in the past 10 years? The smart guys who did those studies, they all said, well, there's not enough outliers. We just haven't seen the big, huge trends.
Yeah, indeed. Well, food for thought, and definitely a good topic for tomorrow.
Does Brendan have any biblical style insights he can share with us, man? I came in late, but I could really use some wisdom.
I think I'm all out of wisdom.
I thought that was a bottomless pit, man. But anyway, thanks for hosting this, Jerry. I'm going to be on here on the regular from now on. It's really great form. Look, if I could just ask one thing about the I'm sure you kind of went over this. For somebody who's not just a CTA only type person, I'm about 70% in CTAs, and then a couple other strategies mixed in. But I mean, to me, it's so much more important to not vol target, and as you put it, kind of let those big drawdowns happen and let your profits run and whatnot, especially when it's a component piece of the portfolio. And it's just so strange to me that institutional investors are looking at vol targeting and essentially taking diversification properties off the table and and profits off the table when it's only a piece of the portfolio. I mean, I was at an RIA where I convinced them to add managed futures to the program, right? And they were so bold, man. They put 5%. They put a 5% position of AQR's mutual fund in the portfolios of these clients. So it's just a pretty nutty thing. Anyway, just pointing that out. But great stuff.
So Woody, I lost you when you said you only do 70% CTAs, so I almost muted you.
So did I.
I'm joking. That's fine. But yeah, I mean, one of the things that bothers me, is sort of self-inflicted wound on the CTAs, and that is talking about Sharpe and volatility management.
Amen.
And when is Buffett? What's Buffett's Sharpe? And here's a guy who has compounded 20% and just made the most amount of money that he possibly could. Sharpe and volatility and drawdown, and when you had that big trade on that made you all this money, did you scale it back because the ATR was, this is the silliest thing, and it's self-inflicted. It's what CTAs talk about, and it's what they want to talk about. And so, and you get a private equity, and you hit a home run, you own PayPal, and Thiel has owned all these companies, PayPal and Uber, and so when they get to talking about these positions, does anybody raise their hand and say, hey, the volatility is pretty high here? No. So what are we doing? It's like, of course you guys are weird because you talk weird, but our whole complaint is outside. Why don't people understand us? Shut the fuck up. Because you're doing it to yourself.
Yeah, it is definitely self-inflicted. The AQR fellows that came in and they actually just met with me. Nobody else was that interested, but they kept talking about their Sharpe, and I'm like, this is going to be, if I'm lucky, I didn't think it'd be 5%. I thought it'd be maybe 10, 15%, but good Lord, they're going on and on about a Sharp, and I'm like, this is a component piece of a larger portfolio. I want a low Sharp, frankly. So yeah, these are all good points. I do think it's self-inflicted for sure. I got to point out, it's interesting that you said to your boys there at the firm that this won't be a losing year because of the consistency, and yet with adding more markets, I'm not trying to point out the just the whatever you want to call it, but then you said with more markets, you're not really that concerned about whether the past quote unquote evidence, which my take on that, whether that kind of bears out or not. But while I agree with you, and while I also, maybe you were just pumping them up, it's just an interesting paradox there. But I was wondering if there was any reason for that.
But just in terms of this thing about managers wanting to talk about Sharp and all of these things, even though we know already that it's not something that's going to put us in a good place, we don't show up well. I do think there's a reason why managers do it, and that is a little bit like what Eric Christensen has done with his product. He's going in and he's basically taking a conversation. He's entering the conversation that people already have in their head. They do it with their product. We, and I say that as an industry, we probably do it because we know that's what the investors are thinking and talking about and the terms they're using. So is there really any point for us to talk about something they don't want to talk about? Or should we instead just say, okay, let's talk along, and hopefully along the way, we can convince you that even if we don't have a high Sharp, we still have a place in your portfolio. I don't know. I'm just putting it out there.
Yeah, that to me is you're stuck between a rock and a hard place. I was thinking the whole time about, you've got to raise capital. I understand that, but I think it's incumbent upon the managers themselves to educate those clients that they want to have, which are clients that are going to listen to this, and they educate them as to why Sharp shouldn't apply to individual instruments within a diversified portfolio, and the whole exercise is ridiculous. So, you're probably going to see a lot of you're not going to see very sticky capital from those folks anyway, I would imagine. Now, I'm not running a freaking hedge fund like you guys, but so you could speak to that better than I could. But I'd imagine it'd be better to try to educate them on the front end and tell them to pound sand if they're not interested. I don't know, but I definitely see the problem.
Well, I think these guys are running businesses and they've been successful at running them. And true, I think the Sharp is low for someone like me. On purpose, I'm not going to want to have a high Sharp. I told you the joke that at one point a few years ago I did get an award for having the best Sharp, and I was like, I'll never let that happen again. But I do think that but the traditional classic is not going to have a high Sharp, but then the typical large CTA is trying to do something about that. But I think that they really agree that in proper money management, you should have a higher Sharp. And so I don't think, I think if I went to them and said, hey, here's $1 billion, don't worry about Sharp or don't worry about vol management, I think they'd say, no, that's who we are. That's what we believe in. It's not like, and I think that the industry is, like, I get no positive feedback except in this group. When I speak to people, I'm naively shocked. I mean, when I talk to people about what I do, I'm just like naive and thinking, well, I can explain it. When I'm done explaining, I'm just like, man, I am really good at explaining. And their response is, no, I don't like that. It's horrible. So I'm just thinking, like, I need to become systematic macro. I'm already halfway there with all these stocks. So I cannot be in this niche any longer because it's just not going to ever work for me. However, I do think that as Niels was saying earlier, if over the next 5 or 10 years, this consistency thing pops up, then possibly people would be able to change their mind and moderate a bit and say, okay, I see what you're saying now. You have everything about your trading I hate, except that one thing that it's very consistent. Well, on an annual basis or something like that. And you could possibly make some inroads there. But I agree totally. I have had no positive feedback from anyone, clients or managed futures.
I never did either when I was running my RIA. And I won't. This is my last comment. I know I'm talking too much. I'm just excited to finally be on with you guys. But I absolutely never, even when trends were rolling and these funds were doing really well. Yours in particular, just no pat on the back for it because they don't understand. It's just complex enough that they don't understand it, and they're used to thinking in the vernacular and the framework of the system, I guess. But it's they don't understand chaotic systems and the fact that a robust system, a necessary quality of that is to have these kind of strong right tail events, which is going to throw off your Sharpe a little bit.
But let me ask you this then. If we were trying to put ourselves in the place of the investors, and let's just not look at cross strategies, because I think this is where we get into trouble looking at something like Sharpe. But if we were just looking at trend followers, we could quantify them and being, they're all trend followers. Okay, they do trend following a little bit differently. They manage their risk a little bit differently. But let's just call it, we're just looking at a universe of 10 trend followers. And I'm being a little bit devil's advocate here. Is there a problem if you have to select one, to look at the Sharpe of these 10 trend followers in isolation? Is there a problem with that? And if there is, what else would you look at?
I don't understand. Is there a problem?
Meaning even if you have a group of just say 10 trend followers, so we're not comparing apples to oranges, we're really apples to apples, only trend following, so we know the methodology is the same and so on and so forth, but we need to pick one, or not we, but the investors need to pick one. My question is, because it's going back to this thing about, are we so much against it that we can't let investors look at our Sharpe? But I'm just saying, if they were just looking at our Sharpe versus someone else's trend, or another trend follower's Sharpe, is that a big issue? I agree it's a big issue if you compare us to a long short equity fund or something else. But if you're just looking at 10 trend followers, you look at the Sharpe over a 20, 30-year track record, is that a big issue? And if it is, what statistics should they be looking at otherwise? Again, only looking at 10 trend followers.
I'll answer that with one word: Sortino.
Skew. I would say skew.
I would say, to be honest, there's no issue looking at any of these Sortino or Sharpe ratio, right? It's more about the understanding how it works. Like having a lower Sharpe ratio is more favorable. But obviously, for an investor to understand that, they need to switch their minds. And in order to get to that point, you need to almost get in their world first before they will get into your world, because, So I don't see any issues with looking at any of these indicators as long as the people understand what is favorable in this strategy.
I think that I'm not sure what the client would choose. My problem is that the Sharpe doesn't translate into capital, the risk of capital loss. The spreadsheet formulas, whatever it is, if we're going to pay attention to them, they should directly impact the risk of capital loss. If we look at a long-term period of the classic trend follower, may have the lower Sharpe, but he may be more consistent. And that's going to pop up but the drawdowns are going to be bigger too. It's just not the right tail events that hurt Sharpe. It's the drawdowns from these right tail events. They are classified as the same risk as having 50 losing trades in a row, which is going to directly impact your capital.
But
But
skew is the answer there, no?
another thing that happens too is it's not just looking at the track record; it's having the interview, and then they have these interviews, and the first four people all say the same thing. They're very large, they're very smart, and they've got very big businesses. They're very successful. And then they get to me, and then I'm saying, no, you got it all wrong. Don't pay attention to Sharpe or drawdown, or you should never vol manage. You should sit with these trades. It's more robust. You're going to have a bigger compounded annual growth rate, and do the hard thing. And they're like, oh my God, this is the stupidest thing ever. Who do you think I'm going to go with? And so it's not just the track record. It's talking to these managers. And if you have this unadulterated love for this crazy, simpler approach, it's just not. I mean, I haven't had any success really in a long, long time of convincing people that this is a better strategy.
Their capital was a lot stickier than those jerks, though. I mean, I don't know. That would be my intuition.
I mean, I think you're spot on, Jerry. I mean, I think all the points you made are absolutely right. I think also this is why Rich and I gravitated towards the Serenity, because I do think you need to take the actual risk of loss and drawdown into it. So I completely agree with that. And I also completely agree with you that it should really also be a combination of quantitative analysis and qualitative analysis. And unfortunately, many of us, having run these strategies for decades, we're not necessarily the biggest, even though we might have the best track record, we're not the biggest, and therefore we lose out. And on top of that, it's an incredibly big ask, unfortunately, that that those who analyze you from these consultancy groups and big institutional investors, that they actually know a lot about trend following. Most of them don't.
And I would say as well, it also depends, obviously, what is their main answers. Because if a person comes to you and they just want smooth returns, nothing else. They don't want the best. They just want smooth returns. And obviously, that's a different ask than someone that wants to maximize their gains. So by understanding what they value first, then that's how you kind of tap into their will.
I mean, look,
you can understand. Sorry,
I anticipate over time. I'm not trying to be an SOB, but I just anticipate over time that, and you have your own list, what is going to fall by the wayside? What has already fallen by the wayside? Okay, let's just say 60-40. That could fall by the wayside, right? Stock only, long only. We've lived through this magical period. That could fall by the wayside. Not that stocks are going to fall by the wayside, but just long only, passive, that could fall by the wayside. Sharpe, I mean, it's possible. It's just not there yet. And you're not going to be perceived as a smart person if you try to buck that trend. Go to the country club in a pair of shorts, jean shorts. No one's going to play golf with you. I'm just telling you, you're out of place.
Jerry, I show up at the golf course all the time in jorts.
That's a man right there.
Woody tweets from the golf course like every day, every Manor Country Club or something.
I live right on the course, man. That's just how it pops up. I'm on the I'm right on the turn there on the 10th hole. So it seems like I'm always golfing. I wish.
Go, Rich.
No, look, I was just going to say that ideally we want investors that, in their 20s who are prepared to stick with us for 30 years. That's the ideal client for a trend follower, someone who appreciates and understands that this is a game measured in decades. But nearly every investor I know, they tend to, chase returns. So they only think in terms of 3 to 5 year sort of horizon, and they're on the latest best thing, and then they say, well, where should I now put my money when that thing underperforms? So they switch and they strategy hop here to there, to here to here to here. they're the ones that look for Sharpe because they're always looking for what is the thing that's producing the smoothest return so I don't get hurt when I switch investments. So the key is to get their mindset away from this immediate gratification. But it's going to be very difficult for many clients who sort of are in their later years, reaching retirement. They're after a conservative strategy, smooth returns. They're after Sharpe. I don't think we can do anything with them, but I certainly think we can do something with those people that want to get into pension plans. So I think we've got to look at this from a 30-year time frame, that sort of thing.
Yeah, us millennials are uncorrupted by that 40-year bond market, and where stocks and bonds were uncorrelated. So I don't know. Maybe maybe you're right about that. I don't know.
I've never had an individual ever mention Sharpe to me.
That's good to know, Mike.
Yeah, I talked to a very sophisticated guy yesterday, and he knows about trend and CTAs. He's a big investor, so I didn't have to. But, I was very careful because to pick a fight, because there's no reason to always try to pick a fight with people. So I want to concentrate on systematic, following my rules, give examples of when I've had trouble when I didn't follow my rules, massive diversification, longs and shorts. And then I'm getting a little nervous now because I'm going to say something about, I like to trade on the long side on individual stocks. And then really out of the limb there if you don't be careful. So I'm not going to try to get into Sharpe. Oh yeah, then some people I talk to every now and then, I'll say, I have kind of an unconstrained volatility with profitable trades. I don't want to cut back on the outlier. I agree. That's why I called you. I like that idea. And I always end by saying, hey, look, we're different, people are looking for different types of CTAs, especially they prefer the short term or, somebody that's really, really different. But throw me in there with these other typical, I'm going to start using that word typical a lot, kind of pejoratively, but the typical CTA, because we're different for no other reason. We're different, and we've made some money for clients over the years. That's not a great. That they usually don't do that. No, I wouldn't call you different. You're weird. It's just good to keep reminding people of the qualities we bring, which is the diversification and the risk control and the ability to turn on a dime that trend following can bring, because you'll get rewarded later for it. And it may not be now, but stand up and tell people exactly what you do and the characteristics of it. I wish I had done more of that in 2008, January of 2008, rather than talking about how we fit into the portfolios better. It would be great to say, hey, don't you realize how dangerous it is not to have diversification, not to have shorts, not to have a systematic approach that goes with the trend. And then when all hell breaks loose with stocks and 60-40, people might remember, oh, that was the one guy who kept reminding me. And I knew what he was saying was true, but stocks have been so good. What was I supposed to do?
But you know what, Jerry? I actually think this is our golden opportunity, because I think we as an industry, or at least some of us, we've realized that we just need to stick to our narrative. We should not be swayed to suddenly call us a hedge fund or whatever we did back in the day when things went a little bit against being a trend follower or being a CTA. And I think if we can stick with this, as we have done now for a while, and given the change we're seeing in the world, frankly, the deglobalization and what that's going to do to financial markets, I think we will win this battle. I think I have never been more convict. I've never had more conviction, and I've never been more optimistic about the prospects of our approach to markets and the importance of discipline, the importance of risk management. I mean, just look at something like Cathie Wood. I mean, yeah, great returns, but you end up giving it all back because it's reckless, long only with leverage. I mean, all the things we stand for, it's pretty much the opposite, except for maybe one thing. They are pretty transparent about the research. I appreciate that. But it's just crazy talk, and empty promises. And I think we stand for all the other stuff, and I think we'll come out ahead.
I agree totally. I've told you many times that because we have the better product, we're going to end up with the most amount of money under management. That more clients will eventually go for the greater diversification and risk control. Maybe after my life, of course, maybe after I'm gone, but it's inevitable that what we do is superior because unless stocks have a permanent, they're permanently better trenders, they're permanently better markets, superior in some way. And then Kathy has her cult. And she has this cult of people. I mean, I think she's had big inflows recently. Did I read that somewhere?
Yeah, she has. It's a
Yeah.
religion over
So she's not changing her message. It's like the crypto cult. Watch half the people in this space start to leave. But it's kind of like just. But look, we have a big advantage over the other cults. Is that we're correct, right? We're offering a good, honest product.
Very, very important point on that, Jerry. I literally, this is why I was late to this Twitter space. I literally just finished a recording with one of my favorite podcasters, Grant Williams. And one thing he brought up at the very end, and he's usually, very careful with picking a fight in public, and that is he from his perspective, the way people see someone like Elon Musk and the support that he has had, similar like crypto, similar like Kathy Wood, that is changing. People are not necessarily standing up to all his crazy ideas as they have been in the past. And I think he's right. And I think this is it's a symptom of something that is much bigger. It takes time to change. It's like a super tanker. But I think some of these people, Michael Saylor, whatever they're called, I think some of these people are going to lose the battle where you can get people to religiously do whatever you say, because the proof is not in the pudding. And so I think we just need to, like we do on these occasions when we talk, we just need to support each other and keep going, because we are definitely on the right path. But it has been very difficult for 40 years to compete with long only, and in the last 20 years with risk parity, where you add leverage to your fixed income. It's been very, very hard to compete with. And I think this has changed.
Yeah, exactly. Inevitably, the emperor has no clothes, and people are not going to be able to ignore it, but for so long. I remember reading my most favorite marketing books. I was captivated by these books and how great they were about how to, market your product, your service, and get clients. And like at the very end of this book, he says, well, the best way for your business to gain clients is to improve your product. And I was like, damn, crap. I thought he was going to give me some shortcut. So it always goes back to, people are going to eventually have to, see the proof, and they can't withstand but so much of nothing but rhetoric and the things that cults do. But I do think when I first learned about trend following, I thought it was the greatest thing in the world. I was 23 years old, and I've only fallen in love deeper since then. And, that really is the type of client we need. We do need clients who really like what we do. And I think at this point, it's inevitable that if that's your requirement, you're going to have a small business. It's really difficult to find people who will love trend following like we do.
Yeah, I always thought from what I understood, it's not the best product. It's not DVD for a while was beating out Blu-ray, and there's plenty of other examples, but it's the best marketer that tends to win. And I understand what you're saying. It's hard to market when you're just losing money year over year, but I don't know. I'm not quite as constructive on the idea that everybody's going to shift into something that, as you put it, Jerry, you run out of breath trying to explain what you do, and people just, for some reason, I mean, it's their freaking livelihood. It's the money that they work so hard to earn, and yet they can't focus in and understand something for 10 minutes. It's just a little too complicated. So it'll take a lot of years of consecutive dominance, I think, for that shift to happen. But hey, that's just one young dude's opinion.
One of the things on our side is that, you know, we've got track records that go back to the sort of 1980s, late 1970s and things, but give us another 50 years and then we've got a additional 50 years track record there. I think, you know, over time, sooner or later, the hammer's going to hit the head and you're going to start seeing reality expose itself.
You know, one of the reason I've always been so complimentary to Salem is because he was just a total stud when he was in a drawdown. He did not phase him to be less optimistic and more importantly, to question the next trades. You know, the next trades, crap. I can't even, you know, sometimes you just feel so bad about these drawdowns in relative performance or absolute performance, or, you know, there's nothing worse than letting a nice profit turn into a small profit. And he was totally unaffected by that. So that's where I want to be. You know, it's easy for me to be bullish on CTA diversified trend following now. I want to have that same attitude when because it should not be any different when we're in a drawdown or whatever. We should be willing to take those trades, extol the virtues of massive diversification, systematic rules, price trend following. And that's difficult, you know, to have that kind of confidence and get out there. But it's something that I think people will remember, and you get rewarded for it many, many, many months later.
This is such a big topic. I almost hesitate to jump in on it this late. But, you know, the thing is, you know, the whole reason that I became an RIA instead of a CTA back in early, say, 2004, is because of it was already difficult enough to try to explain to financial advisors or individual investors, you know, overall money management and trend following type systems and all that to begin with, especially when you really get into the heart of it all, which is, you know, mathematical expectation. And now once they get it, that aha moment is tremendous and they'll never forget it, but getting people to get it. When you go to an individual investor, though, they've not read textbooks telling them that Sharpe is the king. Per se. So, but when you get into financial advisors are extremely uneducated when it comes to markets and true trading strategies, and they tend to focus more on investment strategies where, you know, you're trying to be the Peter Lynch of Magellan to pick the best stocks and hold them for decades, which we all know doesn't work. And you know, and then you get into the, you know, this is a very long topic, but you get into the relative return managers like a mutual fund versus absolute return managers, which is what I am, where I'm more focused on achieving positive returns and specifically asymmetric returns over time in full market cycles, as opposed to relative to some benchmark. I have no benchmark. I'm unconstrained, global, and tactical, multi-market, you know, multi cross-sectional, whatever. And but I focus more on the individual equities because that's what I started with in the 90s, using a CAN-SLIM type approach, high growth, high momentum trends, and then I diversified into other markets through ETFs, going into the early 2000s when ETFs were coming out. I was very early adopting the ETFs because I'd been using RIDEX funds and Pro funds for sector rotation and international exposure and bonds and all that. So, but what I found is, our company started eventually marketing to advisors because I had, a very good track record through the 2005 to 2010, that whole the bull market in commodities and then the crash in the stock market. I had a very good track record through there, so we had it audited and and all that. So advisors were very attracted because they were looking for a solution for their clients because their advisors like to show hypotheticals, they like to show past performance, and they sell based on past performance. And when you're sitting there, in early, say March 2009, and the stock market's very negative, going back almost any time frame, all the way back to 20 plus years, they're looking for something to show their clients in order to get them to stick around or to get money from them. Now, the problem was, though, is that trying to actually explain to advisors or other institutions, they're all pretty much, the same to me, to explain to them what I'm actually doing and how I actually create my results. I was kind of like Jerry is now, where, I'm sitting there with an asset allocator that's managing maybe billions of dollars, and they've got it, invested with 20, 30 managers, and they're wanting to give me a little piece of the overall capital. And I'm sitting at a table in the boardroom with a couple of, highly credentialed, college educated people in basic finance. And they showed me that they're uneducated as to markets and money management because I'm showing them my history, showing them how I did it, which is in very absolute terms. Absolute terms meaning that I'm focused on the price itself and not some derivative that can lead me astray. And I'm the one with the performance that they're looking for, but yet they're looking at me like they're going to give me 5% of a portfolio, and their portfolio was decimated, during this crash of 2007, 2008, 2009. And so I'm sitting there with these people with their suits on, which I rarely wear. And, and I've got my suit on with them, but we're sitting there talking, and I'm getting on a dry erase board for 2 or 3 hours and really drawing it out. But, at the end of the day, they learn what they learn in the books, modern portfolio theory and capital asset pricing model and all this fundamental stuff. And I always found myself doing what Jerry's talking, about, which is trying to get them to convince them that, hey, you don't need to give me an allocation of your money. You need to give me all your money and call me your, I'll be your outsourced chief investment officer, and let me make your overall allocation decisions as opposed to doing what you're doing, because they're sitting here with billions of dollars under management because they're mainly salespeople. And they've been decimated, even with their 60-40 and 20-80 and 50-50, whatever they got. Usually they have 4 or 5 different versions of bonds versus stocks. They were decimated during that time. I'm the one that actually wasn't, and had a good, reasonable rate of return during a very difficult time in bull and bear markets. And they're critiquing me. They're the ones that are critiquing me about what I'm doing. So, but the thing is, at the end of the day, we have to. I don't know who's got the music on, but at the end of the day, I've just decided that I do me. I do what I do, and people either invest with me or they don't. And the ones who do tend to stick around a long, long time. So, but it's just too frustrating to try to work with institutions, and try to get them to do something different.
I think, Jerry S., you have not muted yourself.
Yeah, there he goes. Looks like he turned it off now. So anyway, that's, you're preaching to the choir there, because I think we've all experienced that. I'm sure that Neil's and his firm has, been through that for decades longer than I have, and Jerry certainly for decades longer than I have. But it's I've personally, at 51 years old, doing this for 24, 25 years, have decided not to do that anymore. And of course, fortunately, I don't have to. So I'm just not going to offer our portfolio management to those kind of institutional, professional advisor type people, because what they're really looking for is they're looking for the AQR type. What Asness and his group does. They do a phenomenal job at writing good, simple, fairly simple papers explaining the overall concepts of a strategy, just enough for a financial professional advisor to read it and grasp the essentials of it, and then sell it to their client. And they're doing that because, hey, they always tend to, professionals and advisory firms, they would rather put the money with a relatively larger firm that's kind of well known, with a lot of academic, University of Chicago type people, because it makes them feel better. And if something does go wrong, they get to say, well, hey, it's not like I was giving your money to some guy down the street with, $50 million fund. This was, I think the whole AUM game is a silly game, because the bigger the AUM you have, naturally you're gonna, it's gonna affect your net performance. So I would personally rather, be at 2 and 20 with less than 100 million, stay under the 100 million mark, and keep it, very focused, than I would, running a strategy at 20 billion and being on, being like Kathy on CNBC all the time. With 20 billion at 25 basis points, that's just how I see it. I think that at the end of the day, I've just been far more exclusive and focused on a smaller client base who really get what we're doing, who appreciate what we're doing. And I don't have those conversations, which I just had, by the way, 2 weeks ago. I had a large firm come to us because one of their advisors wanted to use our strategy, and we were in the middle of the whole. We completed the due diligence and all that process. They put me on their system, and there were some issues that I had with how they would execute the trades and how they would do some things, and I declined it. And I'm sitting there, because they were going to start out with a relatively small amount of money anyway, which wasn't really enough to make it worth my while. It was tiny, but it was not but again, you're talking about $11 billion in assets under management, and they're going to give me a spec, almost like a call option, like I would trade a call option. So I just basically said, if you're not willing to ramp this up to a much more material amount, then I'm just not even going to do it. So we'll just wait till after, they'll figure it out eventually, maybe. But I think I'm just personally, Jerry, I'm personally just, not even bothered with that anymore. And I know that I think you kind of want to, I think you still want to be the evangelist, and you are the evangelist of classical trend following. But at the end of the day, none of us really need to or have to. So those frustrations, life's too short for me to even bother with it anymore. But I could tell you a lot of, nowhere near as many stories as you have on it, because I know you've dealt with institutions far more than I have. But I just find every time I sit down with met with a pension or a big trust company or a multi-billion-dollar registered investment advisory firm or whatever, and they got their college educated credentialed people sitting around the board table. But again, I mean, it's just mind blowing to me when I first started, offering our managed program to such investors, after in 2008, 2009, whenever they were contacting us, because they had heard that we did pretty well during that time. And, but they're sitting there, it was mind blowing that they're sitting there critiquing me and interrogating me, and sometimes hanging on certain words and trying to fool me or something, like they're trying to like they can't hardly believe what they're hearing kind of situation. And it's, and I was being brutally honest with them, as I always am, about it, about how we do what we do. But they're sitting there. It's just weird to be sitting at the table with a group that's critiquing me with what I do, and I'm the one that's got the return stream that they would love to have. And if the firm had it, they would have probably taken over half the capital in the country. So it's just you can't. I mean, it goes back to there was a movie in the 1980s when I was in high school. Called Christine, and in that movie, I'll never forget one of the statements that they made about this old car sitting in the barn. You can't polish a turd, and so I just don't polish turds. So if people don't understand it, then that's them, and they do their thing, I do mine. But I don't mind staying a small money manager.
Yeah, one thing about Spaces is that I can mute people where before I couldn't mute on Clubhouse. I would have to kick them off. But now I can mute everyone, or I can mute people. So if you forget to mute yourself, I'll be quicker the next time. But it offers a bit more flexibility. Yeah, I mean, I think I don't have hardly any energy to do any kind of marketing, or I do think though that so it's just talking, and evangelizing, but I'm not doing any work. I do have clients, prospects approach me, and I do a minimal amount of, but I don't agree, honestly, because I'm like you, Mike, and I don't think that my strategy of telling it like it is a good strategy. It would have been better not to tell it, because, that's kind of a selfish thing. I get going on that, but at the end of the day, what you're left with most of the time is not a client. You just had your say. And so I think we all need to, at least I think, I try to really nowadays, since I'm going to put in less effort, with the effort I do put in, I do try to, speak in a way that people are not, I don't want to create controversy. I do like to create controversy with my friends on Spaces and podcast and Clubhouse. But when it comes to clients, I'm trying to just give them all they can take. It's like a missionary. If you're going to go to a country and be a religious missionary, you can only give them so much of what they can handle. Like if you want them to believe in God, they probably have a lot of cultural and historic customs that if you lead with get rid of all of your cultural and historical customs, then I'll tell you about how to join my religion. That's just not going to go anywhere. They can only handle a little bit at a time. So diversification, rules-based. Who can be against those things? I like to follow my rules. I like to trade a lot of markets, shorts as well. Okay, now you're going crazy, but okay, you probably have to admit that you do shorts. Give them a little bit, but most of the time, if you're dealing with high net worth or individual people, they're automatically focusing on that track record and saying, okay, I hear what you're saying. I trust you. I like you. And I like this track record. And I'll kill you if you lose my money because I live right down the street from you. So that's where I've had the most success recently is one-on-one with normal people. I would often go in towards the end of my success of raising institutional money. I felt like I would go in and talk to institutions, and it would be 10 people at the conference room table. And I don't think it's good to be defensive. I get the same way. Who are you asking me? That's just so counterproductive. It's true, but we have to suck it up. But back to these 10 people sitting around the table, I often felt at the end of the conversation, I would be much more likely to get $1 million from each one of these 10 guys or girls sitting around the table than I would from the institution they were representing.
Yep, that's exactly right, Jerry. Exactly right. At the end of the day, somebody mentioned earlier about my asymmetry program and things that you can, probably my observations where I mostly when I tweet, I'm tweeting charts. I'm not tweeting about mathematical expectation, which is what asymmetry is a positive mathematical expectation. But I don't get into the complex system stuff of what I actually do to trade. I'm really talking about more the behavior, the sentiment, the chart, just looking at the charts and it's for fun because, what else am I going to do? Because if you're running systems, then you don't, you can either sit there and play Texas Hold'em online or you can sit and look at charts. And I like charts. So that's what I do. But at the end of the day, at the end of the day, it's all about behavior, and the charts are a representation of the buying and selling action on a daily basis. And that's something that I love, and I love monitoring the overall behavior of people and the sentiment, because that's the most important thing that I do, and I think we all do, but I know for sure that I do is behavioral modification, where we are we're trying to help modify the behavior of some clients need it. Fortunately, most of ours don't. They've been with me for 20 years, so or longer. But some clients need the modifications. They want to compare our year versus say the S&P index, and you can't compare a global tactical all asset unconstrained portfolio focused on absolute returns with very active risk management. You really can't compare that to say a buy and hold stock index with 500 stocks, cap weighted, long only, all the time. More importantly, long only all the time, fully exposed to the risk of the stock market and stocks. It's just not, it's just a silly comparison. It's like comparing a Ferrari to a Honda Civic. And, they're just completely different animals with different objectives. And so, but, that's what the individual does sometimes, but I like individuals, better than institutions, because at institutions, I'm sure to what Jerry just said, the institutions, I've had the people on the committee step aside and want to maybe open an account themselves for them, but maybe because we didn't have, we didn't check the box of, we didn't have $1 billion under management or something or whatever, or we didn't have, whatever kind of, a lot of them want a lot of employees. They want a lot of staff. They want to have some big infrastructure to support. And I started doing this stuff in the late 90s and into the 2000s. So I'm very high tech. I mean, if you're a real systems person, you ought to be eliminating the human error and having less and less people involved, because unfortunately people make mistakes. Computers never make mistakes. If you tell a computer to do something, it's ones and zeros. It's going to do it. You're the one that's going to make the mistake. If it makes an error, it's on you, not the system. And barring that the hard drive doesn't go out or whatever. But a program doesn't make an error unless you tell it to, and so it's your fault. The system is going to do it flawlessly, and that's what I needed, because I wanted that level of perfection. Not in perfection of all the trades are going to be right, because by no means that's ever going to happen. But what I mean is perfection of that I want it to see the signal, see that it looks right, and let me know. And when you try to do that with individual people, as research analysts looking at charts, you're dealing with whatever they got going on in their life. They just had a baby, the other one's dog died, and all this stuff. And you're dealing with, lots of human imperfections. And so in the early 2000s, I started wanting to create more perfection in the actual signaling part of it, beyond myself, and then beyond a group of people that I could hire as research people. And so I started relying more and more on computerized automated trading programs that would generate these signals and then do the money management part of it. But so you actually want to have fewer people involved in your company, not more. So, but do you go to a pension fund, every box that they have is going down the wrong path for what we really should be doing. I mean, they should want less of that, not more. So, but it's frustrating. It's unfortunate because I think we know that what we're doing is right, and Jerry and I are doing it in different ways. He's a CTA doing trading futures and lots of markets and a lot of markets that I don't have access to because I'm trading individual equities and ETFs and options. I can do futures to some extent if I wanted to, but even that, I can only imagine what it would have been like starting off. If I were starting off trading futures as opposed to individual equities and ETFs, and I used to do a lot of options, years ago too, which I still do, but because that's to the average person, that's even more complicated because there's just fewer people trading futures out there, and this is just a whole nother. It's almost like saying cryptocurrency today to those of us that's been doing what we do for 20 or 30 years. But so we kind of all want to be the evangelists. We kind of all want to, have a great fund that everybody can access with $1,000 and kind of save the world with a strategy that hopefully will give them the risk reward that they can accept. But that's another thing too. See, for me in my role, I'm really focused on the objectives of the client, the person, as well. Now we don't do this, 15 different asset allocations and we're going to put you in one of these boxes kind of thing that financial planners do. But we do match up the risk reward profile of our strategies relative to the risk reward profile of the client, because at the end of the day, if they become our client, they're the hero, not me. They're the hero of the movie. They're the one that's the star of the show. I'm just the guide helping them get where they want to be. And I, as the guide, if what I do is fits, then that's great. But if what I do don't fit, and a lot of times it don't for various reasons, then I point them in a different direction because, I'm the guide in the movie. So I just want to point them in the right direction. If they're a buy and hold passive asset allocation person, I show them what Vanguard is, and don't charge them anything for it because that's not worth a fee in my opinion. So, if they want asset allocation, in this typical way that it's done, I show them a very inefficient, low cost way to do it because that's not what I do. And if that's what they want, but I tell you, I really don't have many individual investors coming and telling me that's what they want. I mean, it's really sold. Most strategies are sold. What individual investors really want is they want to have enough money to be able to go on trips and enjoy their life and their kids and grandkids and have, their house and their cars and whatever, they want those things. And you really just got to, show them that this is what we can do to help you get it. And so, it's that right there is a whole, we could have a multi-hour conversation about that because I'd love to hear other people's experiences too. But I just know that I've been even worse than you, Jerry. I've been even more reclusive when it comes to, I guess making our programs available to people and just because, I feel it. I feel you when you talk about these things because I've been there too. But I just sort of, I guess I cut my losses pretty quickly whenever those conversations get started. I'm just like, well, you know what? I mean, you've got it figured out, so you go do your thing, and let me know if I can help. So, but I think that's an incredible.
You do put out some good charts. I enjoy looking at some of your charts. You send them to me. Mike texted me, and then so this morning, during our conversation, Mike was texting me I think it's my Sharpe ratio is in an uptrend. That was what he said. So he sent me a chart of my Sharpe ratio, and it is in an uptrend. So I'll try to do something about that. But I posted this chart out yesterday on Twitter, just a breakout around the S&P in comments to another chart that was put on Twitter, kind of a fake chart, kind of giving the impression that buying highs and selling lows is a bad idea. So I'll put up a real chart that so I was pretty proud of my chart. But anyways, it's been 3 hours. It's our longest ever. I mean, we've never gone anywhere close to 3 hours. So
Epic.
I'm in so much trouble with you know who. I told her this morning that you know, I brought her coffee. I'm trying to give you young guys some marriage advice here. I brought her coffee like I always do in the morning, and I said, hey, you know, I know you just got back from a long trip, but I have my spaces this morning at 8 o'clock. And she's like, no. I'm like, yeah, I do. And she's like, well, she got this impression that I was going to, she said, you haven't changed your opinion on things, have you? I'm like, God, no. Have you ever noticed me to change my opinion on too much? So anyways, she told me I couldn't go 2 hours. So now who's the boss? Who's the man of the family? Yeah, I showed her. But anyways, I'll probably have to pay for it. More coffee, more something, and apologize that I've spent so much time with my close friends here. So, but anyways, it's been fun. And
hey, Jerry.
Yeah.
Hey, I'll add something while that was going on. You know, we have this thunderstorm rolling through Tampa Bay, as I'm sure it hit you too. And my little Shih Tzu coming was scratching at the door. So rather than send you the text of Christy, the picture she took of Domino's standing outside my glass door of my office looking in at me, I'll just tweet it out. It's pretty funny. He wants to come to Dad, and he's got to jump up in my lap every time it starts thundering.
That's right. I have birds as well. They're getting very nervous. It's pretty dark out there here. But anyways, I'm not going to complain. We live in paradise. Anyways, it's been fun. And like I said, thanks for helping me. I feel very prepared. I'm glad Neil's hopped on. We've talked about a lot of this stuff. We'll both be sharp tomorrow. Anyways, you guys have a good weekend. And I look forward to seeing you next Friday, 8 a.m. at Eastern Time. Take care, everyone.
Thanks, everybody. Bye.